Hey everyone, let's talk about Moderna. Look at the ticker right now. They're sitting at $63.32 a share. If you flip on the financial news, you are going to hear a dozen different opinions on whether that price is a massive steal or a dangerous trap. But as focused learners, we don't really care about opinions, do we? We care about the math. Today, we are running Moderna stock through an absolute grinder. We've set up a rigorous 21-model valuation gauntlet to completely strip away the market noise and uncover this company's actual undeniable fair value.
To do this right, we are completely ignoring the media soundbites. We're diving straight into the deep, fundamental reality of Moderna's financials as they stand right now in August of 2026. We're breaking down their cash flow, the balance sheet, the pipeline, and the hard data that trading algorithms often just overlook. Ultimately, we need to answer one question. Are investors paying for a revolutionary medical future, or are they just getting caught up in the hype?
Okay, here's our 5-step game plan for today's explainer. First, the valuation gauntlet. Second, hidden red and green flags. Third, the legendary investor's check. Fourth, assessing the economic moat. And finally, the final verdict.
All right, let's jump right into part one, the valuation gauntlet.
Financial valuation is definitely not a one-size-fits-all kind of deal. So to get the true picture here, we've taken 21 complex financial models and efficiently grouped them into 5 neat little buckets. And wow, does this perfectly illustrate the core conflict with Moderna right now. The cash flow, comparables, and balance sheet models, they are dragging the value way down, some even into the $12 to $30 range. Honestly, the only model group that actually supports the current $63 price tag is the advanced options bucket, which sits at $55 to $75. But here is the massive catch. That specific model price is in near perfect execution of their 25-candidate pipeline. It's essentially assuming nothing goes wrong in clinical trials, which is a massive leap of faith.
So, when you weigh all 21 models together, the true consensus fair value range clusters right here, between $38 and $52 a share. Let that sink in for a second. Pitted against the current trading price of $63.32, we are looking at a glaring disconnect between reality and market hype. The sheer weight of the statistical evidence proves that based on current fundamentals, the stock is heavily overvalued. But as we all know, numbers on a spreadsheet don't tell the whole story.
Which brings us to part 2, hidden red and green flags.
We really need to look at the operational reality. We've uncovered 14 critical media blackout flags, 7 deep red and 7 bright green. These are the underlying business drivers that headline skimming algorithms are totally missing. Let's look at the biggest contrasts. On the red side, we have a terrifying collapse of core product sales. Net product sales actually plunged 18% year-over-year in Q2 2026. But it was cleverly masked on the income statement by a surge in other revenue, like partnerships. Yikes, right? But check out the green side. They are sitting on a massive $5.14 billion cash fortress. Even with their current struggles, that absolute mountain of cash gives them roughly 2 solid years of survival time to turn this ship around.
Now, check out this fascinating cash flow dynamic. The red flag is absolutely brutal. For every single dollar of reported loss, the company is burning 66 cents in actual free cash flow. It is a very heavy bleed. But counteracting that is a massive green flag. They've accumulated between $7 and $9 billion in net operating losses, or NOLs. Why does that matter? Because if they ever claw their way back to profitability, this acts as a colossal tax shield, literally saving them billions down the road.
Let's rapid fire through these final contrasting points. Huge red flag here. Moderna's president, Stephen Hoge, offloaded roughly $18.3 million in stock over just 6 months. You combine that insider selling with the massive costs of their unutilized manufacturing capacity, and it looks pretty grim. But flipping to the green side, the company has drastically improved its cost discipline, slashing over $2 billion in expenses in 2025. Plus, they're aggressively expanding a 25-candidate pipeline covering rare diseases and oncology. It's literally a high-stakes race between their cash burn and that pipeline.
Moving on to step 3, the legendary investor's check.
So how do we make sense of this tug of war? We run it through the ultimate stress test. We're going to take Moderna's metrics and apply the strict, uncompromising criteria of 3 legendary value investors. First up, the godfather of value investing himself, Ben Graham. He looks for a massive margin of safety. Well, Moderna's deeply negative earnings completely break his gram number formula. And when we look at net current asset value, which is essentially what the company would be worth if you liquidated it today, it comes out to a measly $9.50 a share. Trading at 6.7 times its asset value completely obliterates any margin of safety. It's a hard pass from Graham. He wouldn't touch this with a 10-foot pole.
Next is Peter Lynch, the absolute master of growth investing. He relies heavily on the PEG ratio, price to earnings relative to growth, and dividend yield. But surprise, surprise, the formula breaks again. You literally cannot calculate a PEG ratio with negative earnings and negative growth. Toss in the fact that there are absolutely zero dividends being paid out to shareholders, and this is another swift, undeniable rejection. Lynch is out.
Finally, the Oracle himself, Warren Buffett. Buffett famously demands wonderful companies at fair prices, with predictable, positive owner's earnings. Moderna's owner's earnings? A staggering negative $2.75 billion. Their return on invested capital? A dismal negative 39%. So despite having a net cash position, the complete lack of consistent profitability means Moderna fails Buffett's test right out of the gate. 3 legends, 3 massive strikes.
That takes us to Part 4, assessing the economic moat.
Since the raw math and the value legends are flashing bright red warning signs, let's step back and look at their actual competitive advantage beyond the numbers. We classify Moderna as having a narrow moat. Now, their technology is incredibly differentiated. Holding over 1,500 mRNA patents is a massive intangible asset. But, and this is a big but, it's plagued by incredibly low consumer switching costs. For a patient, getting a vaccine is a one-and-done event. If Pfizer or GSK has a similar shot, there is zero brand loyalty stopping a patient from just switching. So their commercial durability beyond the pandemic is still entirely unproven.
And just look at the terrifying downward trajectory of this revenue curve. From a pandemic peak of $18.4 billion in 2021, sales completely cratered down to $1.9 billion in 2025, and their guidance for 2026 only suggests a tiny bump to $2.1 billion. This collapse has been severely worsened by recent setbacks, including the interim failure of their norovirus vaccine and a harsh refusal to file setback for their flu vaccine by the FDA. The hits just keep coming.
Which brings us to our final section, the final verdict.
We've run the gauntlet, we've consulted the legends, and we've measured the moat. It is time to synthesize all of this data into a final, undeniable verdict on Moderna's $63.32 price tag. The data is crystal clear. At $63 a share, investors are drastically overpaying for pure optionality. The consensus across our entire analysis is that the stock is overvalued by roughly 30%. The market is dangerously pricing in absolute perfection from a highly uncertain pipeline, all while completely ignoring the fact that their core revenue has evaporated and their clinical trials are hitting regulatory speed bumps left and right.
There is a quote from the source material that captures this uncomfortable reality perfectly. Moderna is a platform with a pipeline, not a product company with profits. They have incredible, revolutionary mRNA technology, yes, but remember, biotech investing is a game of probabilities, not certainties. Right now, buying at the current price means you are paying top dollar for future probabilities while taking on massive execution risk today.
So, here is where we stand. The 21 financial models are pointing firmly down, but that $5 billion cash buffer and a 25-drug pipeline mean a turnaround isn't impossible. It's a high-stakes gamble. So, I want to turn this over to you. Which side of this are you on? Is the mRNA revolution worth the premium, or is this a falling knife you wouldn't dare catch? Drop your verdict in the comments below. Make sure to hit that like and subscribe button to keep these data-driven explainers coming, and I'll catch you in the next one.